All right, let's get right into it. We hear about tariffs on the news constantly, right? It's always about trade wars and how much more we're going to pay for stuff. But what if I told you they're also sending these huge shockwaves through the world of private equity? Yeah, it's a connection that's not super obvious, but believe me, it is completely reshaping a multi-billion-dollar industry. So, that brings us to the big question we're tackling today. How in the world does a simple tax on goods manage to shake up an entire industry that's worth billions and billions of dollars? Well, the answer tells you a whole lot about how modern investing and our global supply chains actually work.
Okay, so the first and, honestly, the most immediate hit we're seeing is on the very lifeblood of private equity, which is, of course, making deals. All of a sudden, that whole landscape has become way, way trickier to navigate.
What we've got here is a classic wait-and-see moment. You know, the uncertainty from all these tariffs, it's like a thick fog just rolled over the market. And deal makers who absolutely live and die by their forecasts, they're just slamming on the brakes. They're waiting for that fog to clear before they dare commit these massive amounts of money.
So, why the big pause? Well, it really boils down to a few key things. First off, it's just incredibly hard to predict a company's future profits when you have no idea what your costs are going to look like next month. This uncertainty creates this huge gap. It's called the bid-ask spread between what a buyer is willing to pay for a company and what a seller is willing to accept. And when that gap gets too wide, deals just die on the vine.
But it doesn't stop with just future deals. Let's look at how this gets even more intense. Tariffs are putting this incredible squeeze on the companies that private equity firms already own. This is where the theory gets very, very real. This shows you the chain reaction perfectly. It starts out simple enough. A tariff is a tax, plain and simple, and that tax increases the cost of materials. Okay? So those higher costs, they eat directly into a company's profit margins. And when profits go down, a supercritical metric for investors called EBITDA takes a direct hit.
So what on earth is EBITDA? And why does it matter so much? Well, think of it as a pure measure of how profitable a company's actual operations are. It strips out all the noise from accounting tricks and financing decisions. For a private equity firm, it is one of the most important signs of a company's health. And when EBITDA goes down, you better believe the value of their investment is going down right along with it.
And the pain isn't just about the money. We're talking about massive logistical headaches. I mean, companies are literally scrambling to rewire their entire supply chains, and that is both crazy expensive and takes a ton of time. They're looking at all these new strategies like China Plus One, which just means you don't put all your eggs in the China basket, or even nearshoring, which is moving production closer to home just to avoid all these disruptions. So, faced with all this chaos, is the industry just grinding to a halt? No way, not at all. This is actually where things get really interesting. We're seeing this fascinating strategic pivot as smart investors adapt and find totally new ways to win.
See, instead of fighting this tariff battle head-on, a lot of firms are just shifting their focus to sectors that are kind of naturally shielded from the whole mess. Think about it. Industries like software, healthcare, and professional services, they don't depend on importing physical stuff. Their value is in code, in knowledge, in expertise, things you can't exactly slap a tax on at the border.
And here's the wild part, the counterintuitive twist. For some investors, all this volatility is actually a good thing. I'm talking about the firms that specialize in turnarounds. They see this as a golden opportunity. They can swoop in and buy fundamentally good companies that just got hammered by tariffs, and they can get them at a serious discount. This brings us to probably the single most important takeaway from this whole situation. The disruption that tariffs are causing is actually shining a huge spotlight on a fundamental strength of the private equity model itself.
Just think about it this way. If you own a stock in a company, you're a passive investor. You just have to sit there and watch as tariffs wreck the company's bottom line. But a private equity firm, they're an active owner. They can get under the hood, work hand-in-hand with management to renegotiate contracts, tweak pricing, and completely overhaul the supply chain to minimize the damage.
So here's the bottom line, the crucial point. In a stable, predictable world, that hands-on approach is great. But in an uncertain world, it becomes a massive, massive competitive advantage. The ability to actively steer a company through a crisis like this is what separates the winners from the losers.
And that really leaves us with one last thing to think about. As our global economy just gets more and more complex, more unpredictable, maybe the most valuable asset isn't just having money. Maybe it's the ability to adapt. In this new era, maybe adaptability really is the new superpower.